Hello, everyone. Can you hear me okay out there? Is it time for me to be talking? I don't hear any other sounds, so hopefully my sound is coming through. Yeah. Okay. Great. Welcome to the second week of this, and clear lot. Thank you, Eric, and good afternoon to you, Presh. Um, okay. Thank you. Um, Sorry for the confusing start here. I'm a little uh, technology challenge this morning, but that's okay. We're going to move on to some really interesting things. We have an amazing start to the week here, and I've got a guest that I think you're going to like. Brandon Chapman, CMT, is with me. Thank you for being here, Brandon. And thanks to everybody around the world who is hearing this live. Let's jump right to some charts that I think you're going to want to know about if not looking at them yourself already. I'm going to share my screen, and so that we can do that. Let's see, that should be the first one right there. And that's not the screen I was expecting. Yeah, it's okay. You can work with it. Actually, let me go ahead and change the screen one then. Um, hmm. So whichever screen I share, it only wants to share this one. Okay. Moving over. Now, what we've got here is on the left, a comparison between the euro and the US dollar and price of gold. This was as of last Friday. So this is how things finished, right? We've got this blue line, which is just a proxy for the euro. We've got the gold price of gold, tanking right there, and the dollar heading down. A lot changed over the weekend, and so we're going to cover that. In the U.S. markets, this is the sector layout. XLP and XLU are the ETFs which cover the consumer discretionary and the utility sectors. That's the safety trade. That's where money runs to hide if it thinks things are going to be in trouble. So um, they're on the bottom, and they're not showing any sign of changing or tilting upwards. That's all by itself a very bullish signal. Technology is underperforming the SPY, the S&P 500, as of start of the year so far. And financial and energy were trending higher, but with notable downward drafts on just Friday, Thursday, and Friday. So that was the way the week ended last weekend, and that's important for some context before we look at these next two charts. So the next two charts are currency charts and futures charts compared. So we have the Euro USD heading on a decided downward trend. This is the 5-minute chart. So you saw the other one, it looked like it was kind of going up, and then it ended Friday right here, just coming down. What has it done since Friday? Continued with that downward move. And how about the weekend? No gap for the weekend. It went up a little bit, but then pushed right down afterwards. How has the U.S. market futures done by comparison to that? And that's why I put these charts together like this. I like to just sort of say, all right, apples to apples as much as possible. What are these things looking like? So we've got. Let's see if I can make it. No, that was the wrong way. Like that. There we go. And line them up. There it is. These lines the same. See the general trend: U.S. U.S. stock market moving up. Euro also. U.S. stocks start moving down. Euro follows. Now, U.S. stocks are making this big gap and move higher. Uh, S&P 500 futures up 1% pre-market, while Euro is down. Okay, I'm going to take note of that. How about the other comparison pair that matters to us, and that is the NASDAQ and the Aussie yen. So we're going to look at these two here. We'll change that one to the Aussie yen. There it is. Or should be. Come on. Click. No. unlink. There we go. Huh. There we are. I don't know why that was giving me fits, but it was. And same thing, move them together. And you see the Aussie yen and the NASDAQ, if you didn't hear me say this last week, are more correlated than any other currency and U.S. futures pair, and they tend to remain that way. So I always like to look at them at the beginning of the week, and you can see the NASDAQ makes this turn on Friday and gaps higher and kind of holding the gap. And then we've got Aussie yen moving downward, just like the other two charts we looked at, but gapping up. See, so unlike the euro, this thing is moving higher along with US stocks. So it's kind of a mixed opening. Last time we had two gaps up on the currencies, and that told us that we're more likely to have success over the last week trying to do something bullish, and yet a lot of selling last week. So here we have a sort of mixed situation, and I feel like just from these charts alone, we don't quite get a good read, but we do get this notion that there's a lot of indecision. And so I'm going to bring up this one chart right here. This is the S&P 500 SPY chart, which I featured in my Investopedia newsletter using the go, no-go indicator. This is developed by a former Bloomberg terminal developer, a guy who works for Bloomberg on the terminal. And he came up with this particular indicator. In fact, he's going to be my guest next week. So he'll tell us more about it. But the important thing here is what this indicator does is it amalgamates 3 or 4, not stochastics, RSI, MACD, moving averages, Bollinger Bands, and support and resistance. Kind of swizzles them all together into a single indicator. And go means upward trend, no go means downward trend. And the starting signals. Well, we had a go trend back here in November, a reiteration of it, and we do not have a no-go. Despite all the selling activity that happened last week, we don't have a no-go signal. So we're still in an upward trend according to all the technical indicators. Of course, you can just look at the price and kind of see that, but sort of underlying, what's the price action internally looking like, and I feel like this is a pretty good summation of where we are. The trend is weakening. That's why the color's changing blue to green. Trend is weakening, but it hasn't died, and so we want to sort of stay to a weak default of bullish for the week. That's just the quick look of where we are. I'm going to look at a couple of stocks here. I want to note that are doing well being very actively traded. We got in the current pre-market NIO, GOLD, and CCL. That's Carnival Cruise Lines. So we got a cruise company, we got the price of gold, and we've got the Chinese electronic auto making company, all doing well outside of Apple spying QQQ, which you would expect to, have a lot of volume pre-market anyway. What do we do with that information? First off, we notice the fact that it is, those are all sort of risk trades, risk on. This is stuff that people want to try to make big gains with. So that's interesting. It's consistent with what we're seeing. Hey, this stuff's not going away. People are not backing away from the market. They're trying to stay in it, right? And apologize, I'm just trying to get my chat window up. So if you have questions along the way, feel free to chat them right in, because I think you'll find it to be the case that most of the time I can just respond to your questions, whatever they might be. All right, so I want to just take you through in the next couple of minutes, really quick, what it would look like if we were to try and identify or analyze one of those pre-market movers. So I'm going to use GOLD, which is not the price of gold. It's actually Barrick Gold, second largest mining company, I think they're the largest now that they made the acquisition a little while ago. So the largest gold producer in the world, and the price of gold itself. Let's just look really quick at the gold contracts. There we go. See, yeah, you can see how similar the price is. Not the same, but very similar. And what is gold doing? It had the big downward move since then. Over the weekend, it's tried to move up, and it's kind of come back down. So, we don't have a change of trend, that big line going down, no big change of trend. So pre-market, then GOLD, this thing is really moving. People are buying into it for some reason. And what would we do with it? Well, we would take the high at 1925 and the low at 1868, and we would pay attention. And the previous close, and we would consider these just support and resistance areas. Very simple stuff. That's all you're going to try and do is say, well, let me see if I can put on a horizontal line. There we go. And for some reason, that's not allowing me to draw. But those are the price levels you would note at the outset. And if it broke shortly after the market opened, if it broke either one of those lines, then you'd take that as a signal for a trade. If it made it above 1925, you'd say, okay, this thing has a bullish setup. And if it broke below 1865, bearish. So that's the simple thing you do with pre-market stock activity. Here, let's look at NIO and see, this is even more useful actually. See how tight it is? It gapped up and it's in this range. So we know it gapped up, but what's it going to do going forward? Well, the first thing you want to do is find out where are the support and resistance zones pre-market. And then as soon as it breaks out either one of those, there's a signal for you if in fact you're interested in trying to make an entry. Any entry for GOLD, please. So V. Roy asks that comment. Are you talking about the price of gold, or are you talking about that stock, GOLD? Because of course, GOLD would be 1925. How about an entry for gold itself? Well, GLD or gold futures contracts, let me know what you want. Silver, same kind of thing. Silver SLV is the ETF, and you can see it's just barely hanging in there. Before I get to let's do this right now. I'm gonna, if you wouldn't mind, Roy, answering that question, how you want me to answer your gold and silver question, let me know, and I will come back to it. But at this moment, I think it's a good time to bring in our guest, Brandon. And Brandon, you've got your camera going. Can everybody see Brandon in their camera, or on their screen? Sorry.
For better, for worse, right?
yeah, there you go. Thank you. Welcome, Brandon. Good to see you and have you here joining us. I appreciate that.
Yeah.
Effort. It's early here in Utah. Brandon is also in the same time zone with me. And Brandon, you work with TheoTrade, and do you also do your own stuff as well?
I do a lot of just contract stuff. So not under my own brand, but predominantly I work for TheoTrade. So we do live broadcasting through market hours. And so I have an hour every day that I do, and among other things. So I write for their blog, and you can check us out at theotrade.com.
Okay. So TheoTrade, for those of you that don't know, is a website that handles a lot of option information, and it's started by a guy by the name of Don Kaufman. Don Kaufman was one of the early instructors for Thinkorswim back in the day, and when they were doing a lot of their education, he was kind of their main presenter guy, and he knows a whole lot about options, and he does a whole lot of interesting things. But Brandon is not only extremely well versed with options, he is extremely well versed in intermarket studies and sector analysis and various other things. So Brandon, you and I had this conversation over the weekend about the energy and
Mhm.
uh, economic movements that are going on. The energy trade. We saw that chart from last week. How the energy sector is leading. It's been
Yeah.
leading for since the start of the year, pretty much.
Yeah.
Uh, give us your take on that. Can that energy trade continue? Is there legs to that, or and also what's your take on what's driving it? We talked a
Yeah.
little bit about inflation, so just give us your read.
Sure. Well, I think you got two factors, right? I mean, there's the potential weakness in the dollar, which would be represented by inflation. And then the other factor is just the underlying fundamentals of oil. So for example, I mean, last October, one of the areas that I try to specialize in is looking for unusual option activity. And you saw last October in XLE and a lot of energy names, you saw dynamics where a lot of bullish interest was coming in October. And you think about, well, why would they do that? Well, it was all based on the fact that, look, I mean, oil production's down. We have the potential of reopening. Demand could pick up, and very, very quickly, you could see that supplies would really come down relative to historic norms. And in fact, you've kind of seen that. If you look at weekly supply, we're back well into the 5-year range of oil supplies. And with oil production being down over 2 million barrels a day, and imports down as well, you're looking at a situation where supplies could literally push into a territory where we actually have more of a shortage. And for a lot of this most recent rally, in fact, looking at oil futures, it's been pricing in what's called backwardation. That means as you look at contracts going into the future, they're falling in price. And the reason for that is they're expecting a shortage in the coming months. Now, that implied shortage could be a result of printing a lot of money, which we've definitely done, or it could be legitimate, right? Just concerned that if demand picked up, we're just not going to be able to handle it. And last week was a week where you saw every single day big option trades being put on XLE and a lot of other names in the energy space, like Rig, for example, Transocean, Halliburton, XOP. You had some nat gas stocks like Energy Transfer Partners, ET, Range Resources, RRC. I mean, all of these stocks were just seeing just a flood of interest in the last couple of weeks, but in particular, XLE, the ETF that tracks the energy space, saw bullish option interest every single day. So some large, unusual activity every single day last week. And in fact, one of the trades we'll talk about is actually on XLE. And it's one of the trades that were placed last week that seems pretty interesting.
Go ahead and give us that right now.
Well, so
I've
if you
got
go
the
to
chart of
XLE,
up,
yeah, so if you're
on
bringing up XLE, the May expiration.
okay. Let me go get the options. Look at it. Okay.
And, this is, and I understand, I mean, energy's been up a lot, right? If you look at energy stocks, they've gone up a fair bit. I understand trepidation and, is it going to keep going? But the reality is sometimes, it's not a bad idea to have, and if you want to bring up volume and open interest on your layout, Gordon,
Okay.
sometimes it's not a bad to have some upside trades that maybe have very little cost, but a huge reward to risk. So if things do take off, yeah, you can do open interest is fine. Yeah. Because if they do take off, it gives you an opportunity to make some money, right? Because you potentially might be skewed more bearish maybe right now because you're concerned about a market decline. Maybe you're more bullish, but this is a nice one. So for example, if you look at the May 54, you'll see there's about 33,000 open interest on that strike price. So this was a strike price that traders were hitting last week on the 22nd. So if you look at the 53 strike, 33,000 contracts, and then the 59 at 21,000 contracts. And so this is a trade that's 81 days out. We're not talking a long time. But in essence, this trade, this large activity that occurred here is anticipating XLE is going to 58 by May. So again,
That's
that
pretty
gives you
stunning. I mean, we're talking about stuff with 30 and 15 deltas way out of the money there.
Right. And again, you could look at this one of two ways. They, again, maybe again, you want to have very little exposure. I mean, that spread costs very little. It's a low probability trade, but if you're right, it has a huge payout. I mean, it might cost you 70 cents, but yet you have $4.30 of upside. So if you're trying to throw out some stuff to say, hey, if this inflation things really gets out of control, if the fundamentals really start to move in oil or continue to move in oil, this is a very low risk trade, very little maintenance. You just let it run. And if XLE gets above 58, it's a huge payout, which could help offset maybe other areas where maybe you weren't quite as bullish or you weren't quite as much on that inflation tip.
Okay, thank you so much, Brandon. Let me just last week I asked around, and a lot of people were beginners here, so they may not be familiar with option trading. But for those of you who are familiar with option trading, what Brandon's bringing up is really a big deal. So the idea that you would buy the 54 calls out of the money and then maybe sell against them the 59s or the 60s, you would pay the amount that the ask price was. In this case, we're quoting 129 by 171, but that's a bit of an artifact of Friday's close. You know, what they're going to open at, those spreads will tighten. They're not going to be 50 cents apart. They're going to be, probably 5 or 10 cents at most. And then this stuff way out here, similar, the spreads will tighten. And so then whatever you have, Brandon's pointing out that if you had the $5 spread, 54, buy 54 and sell 59, that you might be able to get that for about 70 cents or so. And so what that means, like he points out, $70 per contract of risk, the potential to earn $430. What else, the leftover of the difference. In order to earn that, the price of XLE's got to get up to 59 all the way till, into May, 81 days out. But at the rate it's going, that's not a big thing. This is how significant those are, though. Big 5-digit open interest numbers out here. Look over at the put side. See, if you're ever doing this kind of information and you want to know, well, okay, so there's a lot, but how much is that? Just compare to what the put side is. Typically, calls should run about 2-to-1 for puts. That's 34% is all stocks Russell 1000 stocks. The current stat right now is that the average is 34%, meaning about twice as many calls as there are puts. This is not even close to that. This is 90% calls. So very, very bullish skew. You don't even have a 4-digit number out here on the put side.
Yeah.
And and
great, this is
catch. Thanks.
For those that are like in the statistics world, it's called skew, right? I mean, they're saying, look, they're expecting a much bigger upside move than a downside move, and this trade actually capitalizes on the option pricing that's reflective of that dynamic, that they feel there's more of a crash risk to the upside in XLE right now.
Yeah, and I really love the idea of the supply being the issue. I mean, demand is what everybody's been talking about for the past 6 months. Oh, market's coming back and economy is coming back. So demand will drive it, right? But what we've got right now going on could very well be the constraint of supply. You've got the Keystone oil pipeline shut off like that in January. You've got U.S. Oil production significantly decreased for a variety of reasons. And it's not off or anything, but it is decreased. And then you've got geopolitical forces around the world constraining a bit of supply. If that demand actually were to not go as high as everybody thinks it's going to go, but just go higher at all, and then that supply comes down, that creates a crunch in pricing. That's going to drive things, like you say, a sort of crash higher, a melt up or rapid melt up. Anyway, that's
and recent policies, you mentioned Keystone. I mean, some of the other stuff, it's really driving production offshore and it's driving foreign production. So and that's also the fact we might be importing more sour crude from foreign sources to the US. That's also been bullish pretty well for refiners as well. I mean, you look at like MPC, for example, Valero. I mean, these companies have done really well recently. Even Exxon, right? That's a producer and a refiner. I mean, these are companies that benefit from sour crude because their operations are built around that. And U.S. production it's a little more, it's cleaner, right? And so Valero, if you look in February, it's done really, really well. MPC, and these are names where you've seen some big activity as well. In fact, I wrote about some of the stuff on the blog as well, but for TheoTrade.
Okay, cool. So just to clarify, chat comes in, buy XLE at 54 on 21st of
Yep.
May and sell the 59s.
Yep.
That's the
Exactly. So
out of
very
the money
simply,
debit spread. One of my favorite kinds of trades, really, because it
Yeah.
does give you that tiny, or limited risk, and you can make it as small as you want, but terrific upside. So
if you're, think of it this way, if you're above 59 at expiration, you buy the stock at 54, you sell it at 59, you make $5 minus your initial debit.
Yeah, I mean, thank you. That is a fabulous trade idea. We don't have a whole lot of time here. You want to tell them a little bit about TheoTrade before you go? TheoTrade,
Sure.
you mentioned to me that they have some really interesting educational resources and stuff that you're involved with. If people wanted to follow you, how would they do that?
Yeah. So for example, we have some free resources on our site. So we have our blog that I will generally post one or two articles a day, a lot, even some on unusual option activity. Last week was a big week for us because Don Kaufman did a class on selling options, right? It's called Ultima. And so we spent a lot of time, supporting that class and answering emails. But really we have, literally thousands of hours of video, many different classes. One of the classes is on unusual option activity that I did a number of months ago. We also have our Ultima class and many other classes on hedging. So if you like the concept of vertical spreads, we have systems in there that we teach, all for $99 a month. So I included a link into the chat panel, so for that $99 offer. But yet everything we do, all of the classes, our daily chat from market, just before market open to market close. We've got NASDAQ, day traders. We have option traders. We have three of us are charter market technicians. And so you just have access to all that every day for the sum of $99 a month.
Excellent.
And there's you don't have to subscribe for a period of time. You cancel anytime.
Okay. Thanks very much, Brandon, for that information. And you told me, I asked you that about options information that I know because of my interactions with Don and yourself and others that are part of your team in the past, that you definitely have the upside covered. A lot of advanced information, but you said that you're also assuming beginner knowledge for many of the things you do. And so people who are just walking in, I don't know what an option is, would still be able to find information and resources on your site.
We have a whole category called options for newbies.
Okay.
And my class specifically on unusual option activity maybe assumes you know what a call and put is. So we have options for newbies, but from there, we take you through step by step as far as how to identify activity, how to interpret it, and then how to turn it into a trading idea.
Excellent. All right. Thanks so much, Brandon. And
thanks, Gordon.
Yeah, maybe I'll have to consult with you right before I do the options class that we're doing here at Actions to Wealth in May. I think I'll keep note of this trade and bring it back for the options class at a minimum. But the options class I'm going to be doing is going to be connected to the person getting started and understanding your personality profile, your trading profile, and also understanding some of the things we didn't have time to get into: win probability versus payout. And a lot to be said there in the options world. More control over that particular variable than in the options market than in any other market. So pretty interesting stuff. But all right, we'll definitely have you back, Brandon. You're welcome to hang around for the next half hour till we end, or if you got to get going, totally understand that. Thanks again so much for being here.
Hey, thanks, Gordon. Nice to see you again.
Good to see you again. Well, I want to quickly look at an interesting topic that flared up at the end of last week: GameStop. So GameStop is back in the news, and I want to give my take on it part of what's going on. So the thing about GameStop is people are overinflating the importance of this particular trade, and yet the fact that they're doing it means it's important. So real quick, GameStop is all about the possibility that a bunch of people got together on Wall Street Bets, a Reddit group, user group, or forum rather, and said, shared this idea. They shared an idea. It's been going for months that GameStop was over shorted by hedge funds, and these hedge funds were predatory. That is to say, they did what was called naked shorts. Naked shorts is I want to get short, but I don't actually have a connection to the stock. So if I get out, I have to buy the stock in order to close my position. But if in fact the company goes bankrupt, I get to keep all the money that was credited to my account when I open the trade. Now, if you're a multi-million, multi-billion hedge fund and you can just throw a bunch of money into that short position and pay people to write ugly news and so forth, then that's a real good trade. That's an easy trade. It's a high probability trade. You have better than 50% chance, depending on your metrics, you might have better than 70% chance that that company is going to go under. So you can see why big companies would want to do it. Well, that's the one side. That was, pushing the price down. But Michael Burry, guy famous in the movie The Big Short, his character was someone who saw the housing crisis in the U.S. turning into a financial crisis, and he was early to that. The thing about any trade where you're early is the price of admission to winning in that trade is a lot of emotional stress, because you're wrong until all of a sudden you're right. And being able to put up with other people and your partners or your investors or anybody else telling you you're wrong, and look charts, you're looking at them and you're, oh, I'm wrong. You've got to be able to sort of hold through all that, and then all of a sudden you're right. Michael Burry's famous for that kind of trade. So he comes out and says, actually, GameStop's not so bad. It's not going anywhere. It's not going to go bankrupt from its fundamentals. There's enough people interested. Yeah, mall, COVID, blah, blah, blah. It's not going anywhere. And then so a few Wall Street bets guys took up the cause and said, yes, that's a great idea. GameStop, we should buy it and hang on to it. Treat it like Bitcoin, hold on forever. HODL, as people actually say that. There was just a HOLD misspelled by some guy who was literally inebriated while he was posting, and people have tried to say it means hold on for dear life. No. I mean, maybe it does to you, but so anyway, people taking the hold on forever idea and putting it on GameStop. We're just going to buy it because we love the stock. That's all. We don't claim to be financial advisors or smart guys. We are retards. That's their word, not mine. And we just want the stock. And so they buy it. And all of a sudden, people see this stock go running up to 483 at its peak and then right back down. What happened? Well, a bunch of people caught on to the idea, and it's probably the case that some large hedge funds got stuck in the trade and in an effort to get out, got into a short squeeze. But because it ran up, some people started saying, it's going to go to 69,000, and it's still going. And there's going to be margin calls, and people really want to see this stock go higher yet because of the short squeeze. All of these multi-million-dollar hedge funds having to get out of their positions, right? That's the drama. Now, some people said by the end of February, I say some people, the posters on Reddit, Wall Street Bets, by the end of February, those hedge funds will have margin calls. They will either have to put more money into the trade or they will have to get out. And if the price is too low, not low enough, because if they get in, they want to get out at a lower price in order to make profit. When they go to get out, it's going to be hard. Now, for most stocks, this is not really true. This is not a thing because there are millions and millions, hundreds of millions of shares available, and so if people want in, they can get in. There's always some buyer or seller available at most prices. In the case of GameStop, however, it's a small, what they call float. That's the amount of shares available out there to buy. So you have two things. You have a bunch of people short, and you have a small number of shares, comparatively speaking, that people can go and buy readily if in fact they need to buy. So these shorts have to buy to get out of their position, and there aren't that many shares. That's what creates the dynamic for this rapid move up in price. When it became obvious that the end of the month was approaching and that there could be shorts stuck in the trade, then people started plowing into it just the past 3 days. Both these times, when GameStop started going up and 2 days ago, when this big move happened, the markets went down. There was a lot of selling in the NASDAQ and the S&P 500. Let's see if I can kind of show this off. See right here, the 13th of January, but more particular here, the 22nd of January, where it really started taking off. So this is the moment in time when GameStop crossed $50 a share, that people began to take the Wall Street bets crowd seriously. Like, oh, there really could be a short squeeze. And in fact, there was. I mean, this was either a buying frenzy, a short squeeze, take your pick. It looks like the same thing. But short squeezes really don't last as long as most people think they're going to. Because the truth is, you're a multi-million-dollar company. What are you going to do? You know you're stuck in this multi-million-dollar losing position. Well, you're going to buy options. You're going to hedge. You're going to double down. You're going to do all the things you can do, and in order to cover your position and reduce your losses, maybe even make some profits. You're not a one-trick pony as a multi-million-dollar hedge fund. So when I saw all of this going on, I thought, okay, they're all going to hedge, and then they're going to double down. They're going to go short, and this dynamic that it just sort of crashed right back down and went sub $100 per share, back all the way to 40, made me think, oh, well, that's it. This thing is over. The idea that it popped up again is really interesting, because the question is, were the Wall Street bettors right? Are they actually still going to see a big move to the upside in GameStop? I kind of don't think so. I think this week we're going to see the GameStop trade get done with. It's going to be over. It'll fluctuate a little, but it will deteriorate and it'll head back down to 40-ish, and that we'll see it just sort of fizzle away. The reason there's a part of us that might actually want that to happen. Why? Well, because notice here on the 22nd, what happened in the NASDAQ markets. We got a little bit of selling, but the big selling came on this day, the 27th, right there, as the stock, or as GameStop went parabolic, just jumped way up like this, and this thing goes down. While it's staying up here at these really high numbers, 200, 300, 400, big sell-off. Once this day comes along, this big downward move, you get a rebound, and then this huge gap and follow on. Since then, things going pretty good. Right here, 24th. Where are we with the 24th, 23rd, 24th? We're up this day, but we're down that day. See, and that's the NASDAQ. And we look at the ES, they're similar. Now, to me, this whole thing makes me wonder, are there people out there that know of hedge funds that are really stuck? See, hedge funds get, hedge funds get this help from other, smaller hedge funds get this help from bigger hedge funds or even bigger investment banks to kind of help keep them solvent if they're going to go under and if they're going to have all these troubles. But that help, that reaching out for help, now puts risk on these bigger entities. So now it's possible that these bigger entities have exposure to what's going on in GameStop. All up until now, there's been this inverse correlation. If GameStop's doing well, the market's doing poorly, and vice versa. But today, we're seeing GameStop hold at about $100 a share, a little bit lower than where it closed. And we're seeing the markets up over 1%, 1.28% right there. We're seeing the NASDAQ. This is a really good sign because it means the markets are not afraid of the GameStop trade. And I say it's a good sign. It's a good sign for US investors who want prices to go higher. It's a very bad sign for the GameStop crowd because it means the institutional people feel like there isn't really a worry about GameStop crushing a bunch of large hedge funds and spilling over to the rest of the market. And if that's what most institutional people believe, I mean, these are futures traders. These aren't people that have actually bought shares this morning. These are people that are buying the futures market. So guess who that is? That's institutionals for the most part. They don't believe that there's a market risk to GameStop. That means that they know enough about what's going on. They don't know it perfectly. They don't see everybody else's books, but they know enough to believe that there aren't these hedge funds stuck. They all got themselves hedged and worked out and limited their losses, whatever losses they had. Surely some people had some big losses. Melvin Capital, I don't know, but they've put a cap on those losses. So that's where the market believes it's going. And so GameStop, what's more likely? That it's going to drift lower and lower until this whole thing just kind of goes away, right? Now, maybe somewhere around 20, 30, 40, GameStop's an interesting trade long term if you're that kind of player. I mean, not a trade, an investment. I'm not that kind of person. I'm very short term, 2 weeks to 2 months kind of horizon is what I like to do. But yeah. So why is that important to me? Because I believe it creates a shift in the dynamic of things. And I believe that we're looking at the possibility that more people are going to go ahead and risk in regular areas of the market. We're going to see technology come back. We're going to see discretionary spending. That means Netflix. That means Home Depot. I'm holding a long position there, full. Yeah. So, hi Gordon. Do you think there will be more copycat game stoppers? Hi Helen. Good to hear from you again. I do think there will be for a little while. We've still got AMC doing the same kind of thing, right? AMC is a copycat GME trade. But the idea that you're asking, are there going to be people that try to get together and collectively run up a stock because they think there's going to be short squeezes and hedges for a little while? Surely there will be. It's no different from low price stocks, penny stocks being sort of hyped, maybe maliciously, maybe not by any malintent, just because people are genuinely excited about it. You get all this hype on message boards, people buy in, and then all of a sudden they all start leaving. And so you see what people have come to call pump and dump. And pump and dump can be a real thing where somebody is actually, illegally or unethically trying to entice people to get into a trade so that they can get out. But it can also be just an organic, accidental incompetence kind of thing where people literally think, wow, this is a good investment, and let's promote it to each other and be excited about it. Everybody jumps in, and then other people not promoting it jump out and say, well, that's it. I took my profit. I'm done. 24 days is the magic number with low price stocks. And I believe that the short squeeze, it's the same thing, 24 days or less. That's all the time in the spotlight that any one of these trades would get. So will there be copycat trades? Yes. Do not expect them to be good long-term investments. The sort of buy and hold forever crowd, that's a really dangerous game to play with those kinds of stocks. Okay, so let's look at Wayne's question. Sorry, newbie, but in your guest call in XLE, would you also sell a put with your buy call or just buy a call because it's cheap enough? In the event of doing his trade, where you're going to buy one call and you're going to sell a higher call, you've totally capped your risk. If both of those things go down, you only lose what you put in the trade. You can't lose any more. So buying a put for protection, that doesn't make any sense, right? Now you could say, well, I want to figure out how to be right. I want to figure out how to win regardless of where it goes. Okay, you can do that. The problem is that if the energy just sort of stays flat, then you lose on both sides. So there's no free lunch, right? The thing with options, the best thing to do with options is pick a direction and try to outrun the stats. So you're never going to be sure about one individual trade, but if you make the same kind of trade 10 times and the trade has a 25% probability of winning, say, but you win that trade 30% of the time or 40% of the time or even 50% of the time, let's just say 4 out of 10 trades. If you win 4 out of 10 and you lose 6 out of 10, but when you lose, you're only losing $70. And when you win, you're winning $300 or $400. See how that works? It's like, that's how you win the option game. You've got to beat the stats. The trade that Brandon delivered to us has a very good chance of being in a category of those that would outrun their stats. But there's a whole lot more to that kind of option trading than just a single trade. I'm glad you guys enjoyed that. I'm happy to have Brandon and others like Brandon back that talk about options. But let's make sure we're not leaving people behind there. So last week you said, see how Walmart and Home Depot does. Is the takeaway positive or was it opposite? Correction. Hey, great question. Thanks for the follow-up on that. And also on why did you pick Lowe's and Home Depot? Was it Tractor Supply at the end of last week? Yeah, Wayne, it is a risk reward thing. The sub asks, being on the same idea, the price is 49. Should we wait until the price reaches 54? No. Because when it gets to 54, then what you have is a completely different price structure, right? The price, it'll now cost you $2 or $2.50 to get into that trade rather than $70 to get into that trade. So it's really far out of the money, and the probability that trade is going to go is low. I mean, that it's going to be a big winner. It's not a 50-50 trade. It's like a 20% chance that it's going to win its maximum profits. That's just the math of the way it is. If you win that trade once, you win a lot more than you lose. So if you were to do that same trade 10 times, that'd be a really great idea. One time, you're just rolling the dice. And I mean, it's a good dice roll. Maybe you've got a slightly loaded dice, but that doesn't mean you're going to win for sure, right? If you wait until later, you change the statistical setup. So yeah, anyway, that's look. Now let's go back to Home Depot and Lowe's, because I'm so glad you guys remember that, because those are really interesting questions, and I've got just enough time to bring it up. So my interest in Home Depot and Lowe's had more to do with let's see if I can. Do I have I don't have the spreadsheet here. I will have that ready for you next week. But basically, what I did was I did some historical research on home, or on Lowe's specifically, similar to the research that I did on the S&P 500. So the research I did in the S&P 500 has me believing that we will drift, kind of go up and down, but drift higher until the end of April on the S&P 500. And that in May, we will see this big washout. It might not go up and then cliff dive. It might go up and then deteriorate through late April as earnings start coming out, if earnings come out poorly. But then in May, it'll accelerate, and we'll have a very strong downward move in the markets in May. Hopefully I'll get a chance to share with you why. As we get closer to that period of time, I'll start bringing out my research. But basically, I have this research on a 56-week pattern, which is very captivating. And what I did is I took that research and I applied it to several individual stocks. And one thing that shocked me was that Home Depot looks like, historically, given the conditions of the market, that Home Depot could be due for a 6-month upward move. I couldn't figure out how could that happen if we're going to have this major downward move in the markets, right? Well, there are a couple of ways. One, maybe we don't get a downward move. Number two, maybe the move downward is minimal, and Home Depot keeps going. And third, you've got, what if the market really crashes and then the U.S. government and the Fed and everybody starts even more crazy spending and money creation and so forth. And all of that goes into super low interest rates, which make housing prices go up. And if housing prices go up, people buy houses. And if they buy houses, they got to buy this stuff to remodel or to fix up or to, finish up. Because most time when you buy a brand new house, it's not done. You gotta put in landscaping. You gotta trim the windows. You gotta do all sorts of stuff, right? And you go to Home Depot for all that. So if new homes are being bought and purchased and existing homes are being purchased, then Home Depot is going to benefit. Well, we have been seeing that. U.S. real estate, residential real estate, house prices and housing demand and house sales all continue going up despite all the economic issues and problems. It's continuing to go up. So the move on Home Depot looks like it could be good. Now, the trend looks terrible. The move coming out of earnings looks terrible. We got a no-go signal on that. That being said, I have option positions on both Home Depot and Lowe's. Lowe's just as a follow-on. Lowe's is a little stronger than Home Depot. I'm holding long positions on those, and I'm not closing them. But this week I'll make a decision whether or not I keep holding those. But I feel like we're looking at a dip that's going to settle out and turn around and go up if in fact that research is right. Now, the research is based on going back to 1980, but just because it's happened a bunch of times that way before does not require that it's going to happen. The risk reward is really good on Home Depot right now because it looks so bearish. So guess with more lockdowns, people working on their home improvements too. Yeah, absolutely. If we go back into a new harder lockdown phase, if COVID flares, if COVID 2.0 comes worse, yeah, all of that. If any of that stuff happens, Home Depot and Lowe's, people are gonna, and spring's coming, right? Well, still a little ways away, but that'll happen. And so I kind of feel like the DIY movement is not done, and it might be a little early, but when you're early in the trade, what happens? You got to put through pain. So what I'm doing is I'm holding on to call options, and I keep selling calls against them, kind of like what Brandon was talking about. You buy this one, and then you sell something further out. So I've already done that. I've already sold some options above, and those have expired worthless. So I get to keep the price. That lowers my cost basis in the long call that I've got, the longer dated call. And so I'm just going to keep doing that. Every week, I'm going to be selling options against the longer option I own and reduce my loss. I've got losses, but I've got reduced losses because I'm making profits from the ones I'm selling. And if each week I do that, if the price of these options comes back up, then all of a sudden I'm net profitable and able to hold on for longer. So what I do to keep myself in I've got a big long-term pain trade is that I buy something longer term, whether it's the stock or the option, and then I sell shorter term against it. And we'll talk more about that. That's actually the coolest part of the strategies I'll be sharing in the options class coming up. I'll walk people through step by step how to do what's called diagonal spreads and calendar spreads. Some people call them the what was it? I heard recently the poor man's poor man's hedge fund trade. I can't remember what somebody called that, but it's basically the way to take a very small amount of your cash and make some very, very large potential gains with it. So it works well for small accounts or for using just a small portion of a larger account. And yeah, very, very, very profitable thing that I've coached people on over the years. So if you see the Actions to Wealth class being advertised in May about option strategies, not only am I going to help you identify what kind of trading style is most likely to be good for you personally, I'm going to give you option strategies that will fit that particular personality profile for trading. So that's kind of the stuff we're going to cover now. I want to get back to the question I had on silver, gold and silver real quick. Let's look at the silver trade. SLV is the ETF in US stocks that you would buy if you wanted to track silver. This is a 4-hour chart, so it looks kind of weird. I'm going to change to a daily chart here. Here's silver. Interesting, isn't it? That silver looks like this and gold looks like this. Different, right? Downward slant, silver sideways slant. What's going on? Why the discrepancy? Don't know, but something's got to give. Either gold's going to catch up or silver's going to fall down, right? I kind of think that there's more incentive from big financial players to keep gold suppressed if they can, to trade it lower. So if silver, I'm not a big fan of the silver and gold trade because I feel like unless you're trading them in currencies or futures and can short them, I feel like the short direction is probably the most likely way to go. Now, if I'm wrong, and I'm often wrong, then silver would be the better trade. If you wanted to go long, then you go with the strength. Yeah, it's true, gold might catch up, but I think actually what will happen is whatever is keeping silver higher, keeping it propped up, if gold starts moving up, then the lid of silver will just be taken off and they'll both go up, and silver will probably go up even more. So I can totally understand the interest in the silver trade. Silver futures, then let's have a look at what that's doing. So quickly, the 5-minute chart so we can see the over the weekend stuff. We got this bounce, we got this short steep downward trend that's broken. What would you do with silver? You'd pay attention to these levels in silver futures right there at 26.70 for the low and 27.17 for the high. A breakout to either one of those is a directional signal. I would really be looking close for the 27.17. If in fact we see silver futures cross 27.17, then go looking for trades to the Ash is good at doing that, hedging his stocks, right? Do you have some input on what is keeping gold down? I'm not one that believes politics has as much influence on markets as people and newsmakers, news writers want to suggest. I believe that the markets do what they do, and politics tries to come up with explanations for it after the fact, or news tries to come up with explanations after the fact, and they point at politics. So here comes silver out of the gate. Markets have just opened, and what's happening? Silver is making an initial jump. Oh, retracing. We'll see. And so what do I think is actually going on? I think that if we see the dollar going up in value or price, mathematically, all things you buy with the dollar has pressure to go down. And so that's the easy explanation. If in fact dollar is going to continue going higher, metals are likely to go lower. And the converse is true. If the dollar's sliding, then you should see metals going higher. Well, we saw the dollar slide for a long time from November until the beginning of February, and gold didn't, spike higher. I mean, it kind of went up a little, but not much. And lately it's been kind of going down. So that is a really important question. Why is gold going down? If inflation in the U.S., if other commodities are roaring higher, like oil and other commodities, right? And platinum's going higher. Why isn't gold going higher? It could be that there is market manipulation. I don't have any proof of that. All I know is that the charts show me it's going down. And I can theorize all the sorts of reasons why that is the case. But until gold and silver come in alignment and start doing, mostly similar things, then I know whatever is going on that's making gold do something weird is still going on, right? It's not a healthy market when you see gold and silver. It's not a healthy commodities market when you see gold and silver doing different things. And so don't plan on that market acting rationally. That's where I am with gold. I look at gold and I think it's not making sense, and it's probably going to continue to not make sense until we see gold and silver start to do the same things. And silver's trying to make up its mind what it would do right now. All right. What do you think of the new gold mining sites in Canada that Ash researched? I don't know. I don't know. I haven't researched gold to that level, right? Gold miners. I love watching gold miners when I see gold prices starting to go up, and particular GXDJ, Junior Gold Miners ETF. If that thing starts looking bullish, then all of a sudden I go and pay attention and find what's the hot gold mining stock to get in. Until then, I just watch gold and silver, and we got silver reversing to the downside. So, I mean, that actually kind of fits more of my expectations. Gold and silver being pressed down. All right. Wow. So much to say. Let me just quickly tease about next week's guest. Next week's guest is Alex Cole, who will be here to tell us about his invention, the go, no-go indicator, on the available on various charts, and premium versions of it are available. Alex is a CMT like myself and like Brandon, like most people who I will probably bring on, but not necessarily all. I really hope to have some interesting guests come on, especially former students that I've coached. I've got a few of those lined up in the weeks to come. And I think also soon in the next few weeks ahead, I will be bringing out my 56-week research. So I probably won't have a guest that week, just give myself the time to talk about the stuff that I've done so that you'll know what it is I'm talking about and why May 14th is a big red letter day. And you want to learn how to benefit from downward moving markets before that day. So we will be talking about how to take advantage of a big downward move in the markets if in fact it does come, and how to make sure you don't get soaked if it doesn't come. The best thing about a big downward move in the market is on the other side of it there's a huge upside opportunity, and those are usually very low risk, high reward trades. So we want to be able to capture both sides. We want to capture a big downward move, and we want to be able to recognize when is it done, how do we jump in and get the big upside. I am hoping to prepare you in the next 8 weeks as that comes along to be ready for that moment in a way that few other people will be ready for. So stick with me in the coming weeks. Lots of interesting things, lots of education, and lots of opportunity to take advantage of. Until next time, we'll see you back on Charts and Chats with myself. Take care.